Is the stock market a ticking time bomb? We've seen markets skyrocket, but are we in a bubble that's just about to pop? In this video, we'll break down 3 powerful indicators that legendary investors use to determine if the stock market is overvalued or in bubble territory. How's it going, everyone? My name is James Santiago and you're watching your show, Learn Wealthy. And today we're talking about the Buffett Indicator, or the market cap to GDP, the Shiller PE Ratio, or the CAPE ratio, and the market cap to M2 money supply. At the end of this video, you will know how to read these indicators and whether it's time to stay on the market or cash out before the next crash. But remember, this is not an investment advice, and this is only the macro view of the stock market. Of course, you still have to study the individual stocks that you're investing into, but knowing the macro view can give you a better edge on your investment decisions. Part 1, the Buffett Indicator, or the market cap to GDP. So what is it? The Buffett Indicator compares the total U.S. stock market value, the market cap, to the United States gross domestic product, the GDP. If the stock market is growing faster than the economy, it's a warning sign. If the stocks and GDP grow together, it means valuations might be reasonable. Key levels below 75%, investors are suggesting the stock market might be undervalued. Maybe a good buying opportunity. 75% to 100%, the stock market might be fairly valued, and it's just as growing as fast as the US economy. Over 100% is suggesting the stock market is overvalued, and over 150% is bubble territory. And right now, the Buffett Indicator is hovering around 203%. We're using the S&P 500 right now as a proxy for the stock market. And that means the stock market is more than twice the size of the GDP. That means the stock market is more than twice the size of the US economy. Meaning that the stock market is way more overvalued than the actual US economy. Historically, look at this, when the Buffett Indicator goes above 150%, we have seen massive crashes. Dot-com bubble, 2008. So does this mean a crash is coming? Let's check another indicator. Part 2, the Shiller PE Ratio, or the CAPE ratio. What is it? The Shiller PE Ratio, or the CAPE, cyclically adjusted price to earnings, looks at the last 10 years of earnings, adjusting for inflation, because regular PE ratios can be misleading in booms or recessions. The Shiller PE smooths out short-term noise. Key levels: 16 to 18, normal valuations. Above 30, overvalued. Above 40, we have a bubble warning. Historical perspective. Dot-com bubble year 2000. The Shiller PE was about 44.2. The market crashed. 2008 great financial crisis. The Shiller PE was 27, nearly overvalued, and stocks tanked. 2021, post-COVID boom. The Shiller PE hit about 38. Stock market overheated and crashed. And right now the Shiller PE ratio is around 37.9, which is higher than historical norms. That means stocks are expensive relative to earnings. But earnings alone don't tell the whole story. Let's check liquidity. Part 3, market cap to M2 money supply. What is it? Market cap to M2 compares the total stock market value to the money supply, or the M2, which includes cash, checking deposits, and liquid assets. Why does this matter? If stock prices are rising just because of money printing, that's not real growth. A high market cap over M2 ratio means stocks are inflated by easy money. Key levels. Low ratio means that stocks are supported by real earnings. A high ratio is saying that we have a liquidity-driven rally, potentially a bubble. Right now, market cap to M2 suggests that easy money has been a major factor in stock prices. But wait, there's more. Now we have rising interest rates, Federal Reserve's tightening, and liquidity is drying up. The fuel behind the stock market's rise might be drying up. Final verdict: is the market cap overvalued? Buffett Indicator overvalued. Shiller PE overvalued. Market cap to M2 ratio saying we have a liquidity-driven rally. So yeah, it looks like the stock market is historically expensive. And historically, it looks like we have a pretty big risk for a correction. What should you do? Number one, be cautious. Don't FOMO into overvalued stocks. Don't have a recency bias. Understand that past performance is not indicative of a future outcome. Focus on fundamentals. Remember, buying a stock means you're actually buying a piece of a company. Think like a CEO or a company owner. Invest in companies with strong earnings, is holding a significant amount of cash and assets. Make sure they have a good ratio between their assets and their liabilities, and make sure they are making profit and cash flow. It's also important to understand intangibles, things that you cannot make a data out of, like the company values, the CEO's mindset, and where the company is headed. You need all the information you can get to make the best investment decision. And number three, diversify. Not just pick different kind of stocks, but diversify into other asset classes like real estate, gold, and other cash flowing assets. Maybe lean on investing in growth stocks more when the stock market is undervalued, and maybe lean on investing in safer, more stable dividend stocks when the stock market is overvalued. Do you think the stock market is overvalued, or is this a new normal? Drop your thoughts in the comments. And for more finance, investing, real estate, and macroeconomics, let's all learn wealthy together. I'll see you in the next video.